In today's episode of the Daily Brief, I'll talk about three interesting stories. I first talk about the crisis in microfinance. I then discuss some interesting details about Burger King India's struggle. And finally, I talk about Tata Technologies' decline in profits. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host, Akshara, and today is Wednesday, 30th October. Before I begin, on Daily Brief, we cover the biggest stories in the markets, but we don't cover specific market movements. One of the most common requests we've received from you was for a newsletter and video that does exactly this, summarizing what happened in the markets on a given day. We heard you, and we've just launched a new newsletter called Aftermarket Report. In this newsletter, we'll give you a really concise summary of market movements and key developments in both Indian and global markets. Before we start producing a video version, we'd like your feedback. Is the content in the newsletter good enough? Should we add or remove anything? The link to the newsletter is in the description. Please read it and share your thoughts, and we'll start working on a video version soon. Microfinance in India started with a simple goal: get loans to people who really needed them but couldn't access traditional banking. But now, it's hit a complicated patch with some serious challenges around rapid growth, changing rules, and sky-high loan rates. The Reserve Bank of India, or RBI, is having to take a hard look at how they oversee the whole thing, especially as more loans are going bad and the quality of these loans keep dropping. In 2022, the RBI made a decision that really shook things up. They scrapped the cap on how much interest microfinance institutions, or MFIs, could charge. The old system was pretty straightforward. MFIs could take their cost of getting money and add 12% on top. So if it cost them 10% to get funds, they could charge borrowers up to 22%. This worked well. MFIs could cover their costs and make enough profit while borrowers weren't getting crushed by impossible rates. But when the RBI lifted this cap, hoping market competition would keep rates reasonable, things went sideways. Instead of the competition driving rates down, many MFIs just cranked them up, some going as high as 45%. RBI Governor Dr. Shaktikanta Das actually addressed this head-on in a CNBC TV18 interview, admitting that they'd miscalculated. The market forces they were counting on just didn't materialize, and now they're having to come up with new ways to protect borrowers. Adding to these problems is a tricky situation with how borrowers are identified. Around 2017, the sector switched from using Aadhaar cards to voter IDs as the main way to identify borrowers. This might sound like a small change, but it's caused huge problems. Voter IDs just aren't as secure as Aadhaar, and some people have figured out they can use different IDs to get multiple loans from different lenders, what the industry calls over-leveraging. This is a big reason why we're seeing more loans go bad. Take Credit Access Grameen, or CA Grameen. They're a perfect example of both what's going right and wrong in the industry. Their numbers tell an interesting story. Their loan portfolio has grown to Rs 25,133 crores, up 11.8% from last year in Q2 FY25, which sounds great. But dig deeper and you'll find some concerning signs. Their portfolio at risk, or PAR, loans that are more than 15 days overdue, is at 1.5% nationally, which doesn't sound too bad until you look at specific regions. In Bihar, it's a whopping 8.9%. They're playing it safe by keeping provisions 1.79% above what regulators require, giving them an extra buffer of Rs 431.1 crore. Even with these precautions, their profit after tax, or PAT, still dropped by 46.4% year-on-year to Rs 186 crore, showing just how much these problems are affecting their bottom line. Different banks are taking different approaches to handle these challenges. IndusInd Bank has 9% of their total portfolio in microfinance, and they're seeing more loans go bad, especially from newer borrowers who are higher risk. Their response? Set aside more money for potential losses while still staying committed to microfinance. Kotak Mahindra Bank's taking a more cautious route. As their CFO Deepak Gupta puts it, we restricted growth because we were seeing some strain. We expect this trend to continue for the next quarter or two before stabilizing. While some states are showing improvement, others continue to face challenges. They're focusing on areas where people have good track records of paying back loans. The RBI isn't reimposing rate caps, at least not yet, but they're definitely stepping up their oversight. They're doing more through inspections to watch how MFIs set their rates and treat borrowers. They're requiring MFIs to be completely transparent about all rates, fees, and penalties. They're looking at possibly setting different rate caps for different regions, especially where borrowers are more vulnerable. The sector is actively working on solutions while trying to keep operations sustainable. Revenue diversification. Major players like Credit Access aren't just sticking to loans anymore. They're moving into microinsurance and other financial services to reduce their dependence on high interest lending. Digital transformation. The industry is pushing hard into digital platforms, hoping to cut operation costs and potentially offer lower interest rates as a result. Credit infrastructure. There are plans for a centralized credit bureau that could help prevent over-leveraging by tracking all of a borrower's loans in one place. The industry is clearly at a turning point, trying to balance making money with actually helping people, all while dealing with stricter oversight and making sure borrowers don't get in over their heads. Now, moving on to the second story. Why is Burger King India struggling? Restaurant Brands Asia, or RBA, the company that operates Burger King in India, recently shared its financial report for the quarter ending on September 30th, 2024. The broad takeaway here is that Burger King, as well as the overall Indian fast food industry, is facing a bit of a tough time. Losses here are growing, largely due to changing consumer habits, rising costs, and fierce competition within the Indian fast food market, especially for Burger King. So the question is, what does this mean for Burger King and the Indian fast food market? Why are these issues happening now? And what does it really mean for all of us? Let's discuss all of this in this story. To start with the financials, Restaurant Brands Asia posted a net loss of about rupees 60 crores for this quarter, which is a significant increase from the rupees 46 crores that they lost during the same quarter last year. But that wasn't the only problem. The brand's revenue, which in simple words is the money earned from sales, grew only by 1%. And this 1% growth rate is the slowest that Burger King India has ever seen in the past 3 odd years. This slow growth rate could suggest that fewer people are spending money at Burger King and fast food outlets. The reason could be either that people are eating out a little lesser or they're spending a little more cautiously. During a recent earnings call, Restaurant Brands Asia's management team mentioned that foot traffic, or the number of people visiting Burger King stores, has also dropped. This has particularly affected existing stores where growth has now become negative. There's also a metric called Same Store Sales Growth, or SSSG, that's tracked in this industry. This measures how well stores open for a year or more are performing compared to previous periods. Unfortunately for Burger King, this metric was also down by about 3% this quarter. This is a drastic change from the 3.5% growth that the company saw in the same quarter last year. The question here is, why is all of this happening? Multiple issues have come together to create this challenging situation for Burger King India. Let's take a look at a couple of the main factors. Number 1, decline in same-store sales. One of the biggest factors has been a decline in sales at older stores where fewer people are visiting or spending. This decline in foot traffic shows that people are becoming more cautious with their spending, particularly on fast food and dining out. This reduced demand in India's fast food market has pulled down Burger King's overall performance. Number 2, rising operational costs. Running fast food restaurants can be expensive. According to RBA's management, the total expenses for running stores this quarter have climbed up by about 3% and have reached close to rupees 700 crores now. The rise is mainly due to increased cost for materials and rent, which are squeezing the company's finances and making it hard to keep profits steady. Now, even though all that we've spoken about so far is a bit specific to Burger King, this also reflects a broader trend across India's fast food sector. Many major fast food chains in the country are facing similar problems. Companies like Sapphire Foods, which operates Pizza Hut and KFC, Westlife Food World, which operates McDonald's, and Devyani International, which runs Yum brands, have also lately seen slow sales along a very similar trend. So, the entire fast food industry in India is currently going through a difficult period. And it could broadly be attributed to two reasons. Number one, consumer spending caution. A lot of people in India are becoming more cautious about where and how they spend. The retail inflation rate for September was 5.49% year on year, up from 3.65 in August. This means the overall cost of living has gone up a fair bit. This leaves people with less money for non essential spending like dining out. Fast food outlets like Burger King, which are seen as occasional treats rather than essentials, are particularly affected as consumers save more. Number two, competitive pricing pressures. In an attempt to attract more price conscious consumers, Burger King and many other fast food companies introduced cheaper items for as low as rupees 50. But while customers are interested in deals, many are still hesitant to spend even on discounted menu items. So while price cuts may help to an extent, they aren't a complete solution to the current slowdown in spending. But despite these challenges, RBI seems to be optimistic about Burger King India's future. They've planned out several long term goals like digital expansion, improving profit margin by adjusting delivery pricing and supply chain operations, and expanding stores to cater to a wider audience base. Broadly, the RBI's management is looking at a consistent and planned growth rather than quick reactive changes. For now, though, the company faces a bit of a balancing act between attracting customers and managing costs. When the broader economy stabilizes and consumer spending picks up, Burger King India may be well positioned to capture a larger piece of the market. But until then, they and other fast food companies continue to hope that they can weather the storm. And finally, moving on to the third story. Why are Tata Technologies' profits declining? If you're someone who's curious about what the future holds for cars, planes, and even industrial machines, Tata Technologies is one of the companies you probably cannot ignore. Now, this isn't your regular tech or IT company. Instead, it's deeply involved in engineering, design, and manufacturing, the actual building of machines and factories. So, when it comes to what vehicles and factories will look like tomorrow, Tata Technologies plays a crucial role. To get a sense of how Tata Technologies fits in, think of it as a company helping industries like automotive and industrial machinery build the brain of their products, figuring out everything from design to how it will be manufactured. They partner with companies to make these products work efficiently, safely, and with advanced technology. Now, to understand Tata Technologies better, it helps to know the difference between Tata Technologies and Tata Elxsi, another company that's part of the larger Tata group. Tata Technologies. Think of them as the engineers focused on how a car is built. They work on the car's core, its structure, safety features, and the technologies that make it run smoothly. They handle how the car operates and how it's built. Tata Elxsi. They're more about the experience inside the car. Tata Elxsi focuses on digital interfaces, infotainment systems, and features that enhance user experience. Essentially, Tata Technologies builds the brain, and Tata Elxsi makes the experience enjoyable and user-friendly. Tata Technologies isn't just based in India. It's a global player. They operate across several countries, which brings in revenue from different markets. 36% of their revenue comes from India. 24.2% of revenue comes from the UK, where they're deeply involved in automotive research and development. 20.4% is from North America, where they work on manufacturing projects. So they're well positioned across markets that each have unique needs, from automotive innovation in the UK to large scale manufacturing in North America. In terms of their products and services, Tata Technologies has two main areas. Tata Technologies derives 77.7% of its revenue from automotive services, which includes engineering for car makers, product lifecycle management, and digital solutions for vehicle design. The remaining 22.3% comes from technology solutions, offering software reselling and workforce training to help industries adopt modern engineering tools and enhance their skills. Now on to the latest quarterly news. Tata Technologies reported a 2% drop in profits, bringing it to Rs 157 crores. This is the third quarter in a row where profits have shrunk even though revenues did grow slightly by 2.2%. But with clients being cautious, Tata Technologies' profit margins have been shrinking, which means they're making less profit on each rupee earned. So, why is this happening? Over the past few quarters, their major clients in the automotive and industrial sectors have been hesitant to launch big game changing projects. Instead of committing to large deals, clients are making smaller investments, which directly affects Tata Technologies' earnings. This slowdown has a few underlying causes that affect Tata Technologies' core markets. Let's look at them in more detail. Number one, economic and regulatory uncertainty. In the US and Europe, economic uncertainty is making clients hesitant about large projects. The US elections add to this wait and see mindset while European clients face pressure from Chinese EV manufacturers and await potential government support. Tata Technologies CEO Warren Harris noted that recent deals are smaller, with clients taking a cautious stance until conditions improve. Number two, shift from full EVs to hybrid vehicles. Many car makers, especially in North America and Europe, are moving their focus from fully electric vehicles to hybrids. Hybrid vehicles meet environmental standards but don't require as much costly infrastructure as EVs. Tata Technologies, which has invested heavily in EV projects, now finds that growth in this area has slowed as clients favor hybrids over EVs. This affects Tata Technologies' EV related projects like battery integration and electric powertrain design. Number three, EV market hesitation. The EV market has been a significant focus for Tata Technologies, especially in designing battery systems and electric powertrains. However, high costs and regulatory delays have made clients hesitant to invest in large scale EV projects. Tata Technologies CEO acknowledged this, noting that clients are rethinking their investments in EVs due to high costs and the lack of clear regulatory support. While EV projects are slowing down, Tata Technologies still has other key revenue areas that are doing well. Digital manufacturing. Tata Technology enhances production efficiency through automation and AI, though clients prefer smaller improvements over big investments. Education and training. Working with states like Maharashtra, Tata Tech offers engineering, upskilling, providing stable but limited revenue amid EV and manufacturing slowdowns. So, despite a challenging quarter, Tata Technologies remains optimistic about the future. The company expects that as economic and regulatory uncertainties clear, clients will regain confidence and start investing in bigger projects again. As Warren Harris put it, they're facing short term challenges, but the fundamentals of their business, like the shift towards EVs and digital manufacturing, remain strong in the long run. Moving on to the final segment of the day, Tidbits. Number one, India's long postponed census is set to begin in early 2025 with results expected by 2026. This census will guide the redrawing of Lok Sabha constituencies, a critical step in reflecting demographic changes. Number two, Bharti Airtel's profit jumped 168% to rupees 3,593 crores in Q2, driven by tariff hikes and premium customer acquisition. The telecom giant also announced a structural reorganization of its DTH and broadband businesses for future growth. Number three, the RBI is rolling out an AI based system for real time cyber fraud detection, boosting digital transaction security through centralized monitoring and tools like Mule Hunter AI. Number four, Apple's iPhone exports from India surged to nearly $6 billion, showcasing the tech giant's commitments to diversify its supply chain and increase production outside of China. And those were the big stories of the day. I'm your host Akshara, and this was the Daily Brief. See you in the next episode.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.